All right, we're going to put on our detective hats today. We're going to uncover what's really going on inside a business by following the one thing that never lies, the cash.
So let's just kick things off with a bit of a puzzle, a real head-scratcher that gets a lot of people. Picture a company, right? It's all over the news, reporting millions in profit. Looks fantastic on paper. But could that same company actually be about to go bankrupt? And believe it or not, the answer is a huge yes. This isn't some kind of trick question. It gets right to the heart of a huge idea in finance, the massive difference between saying you made a profit and actually having cash in the bank to pay your bills. Okay, so here's the deal. Profit, that's really just an accounting idea. It's based on something called the accrual method. All that means is you can book a sale the second you make it, even if your customer isn't going to pay you for another, say, 60 days. But cash, well, cash is just cash. It's the real, actual money in your bank account. It's the lifeblood of the company, what you need to pay your employees, your rent, and keep the lights on.
This leads to a classic saying you'll hear all the time in finance. Profit is an opinion, but cash is a fact. See, profit has all these estimates and accounting rules baked into it. It can be shaped a bit. But the amount of cash sitting in the bank, well, that's a hard number. It is what it is. So to get the real story, we need a tool that ignores the opinions and just follows the facts. It follows the money.
And that tool, my friends, is the statement of cash flows. Honestly, you should think of it as the financial world's version of a detective's case file. It just cuts through all the noise and shows you exactly, line by line, where a company's cash came from and where it all went. It gives you the clearest possible picture of a company's ability to survive and hopefully to grow.
And this report, this investigation, it's broken down into 3 key areas. Each one tells a totally different part of the company's story. We've got operating, investing, and financing activities. So let's crack open the case file and start with the first one.
All right, part 1, and you could argue this is the most important part of the whole thing. It answers one simple question. Is the company's main day-to-day business actually bringing in any cash?
This section, operating activities, is all about the cash that comes from the company's core mission. Whatever it is they actually sell. If you see a positive number here, that is a very good sign. It basically means the fundamental business model is working. It's sustainable.
So, how do we get to this magic number? Well, this is where it gets really clever. We actually start with that opinion number we talked about, the net profit from the income statement. And then we make a bunch of smart adjustments to work our way back to the cold, hard fact of cash.
Let me break that down for you. First, we take that profit number and we add back any expenses that were on the books but didn't actually involve cash leaving the building. The classic example here is depreciation. That's just an accounting concept for how an asset, like a company truck, loses value over time. No cash actually changed hands. Then we adjust for timing differences. So think about it. If your customers owe you money but haven't paid yet, that's profit you've recorded, but it's not cash you can spend. On the flip side, if you're taking longer to pay your own bills, that's cash you get to keep in your pocket for a little while longer. All these tweaks and adjustments get us from that fuzzy profit number to the true cash picture. Okay, so once we know how much cash the main business is actually generating, the next question is, what's the company doing with it? And that brings us to part 2 of our investigation, investing activities. This is all about how a company is spending money to build its future. Investing activities are all about the cash being spent on, or maybe made from, buying and selling big, long-term stuff. Think buildings, machinery, or even other companies. This is where you can literally see a company's strategy in black and white. Are they confidently pouring money into new technology to grow? Or are they selling off their assets just to scrape together some cash?
So when cash goes out here, it's usually for things like buying a new factory or upgrading equipment. When cash comes in, it might be from selling off some of that old equipment. Now here's a key point that might feel a little backwards at first. A big negative number in this section is often a really good thing. It shows that the company believes in itself and is spending its cash to invest in future growth.
So, if a company is spending all this money on its future, but the main business isn't generating quite enough cash to pay for it all, where does that extra money come from? And that leads us to the final clue in our investigation, financing. This is the last piece of the puzzle. It shows us how a company gets money from outside sources, like banks and investors, and also how it pays them back. It's all about how the business is funded.
So cash comes in when the company issues new stock to owners or, takes out a new loan. Cash goes out when it pays back its debt or pays dividends to its shareholders. This section tells us, Are they leaning on debt to grow, or are they bringing in new owners to help fuel their ambition?
So there we have it. Our three big clues: cash from operations, cash from investing, and cash from financing. Now we get to put them all together. And just like a good detective, we can piece together a really compelling story about what actually happened to this company over the past year. So how do you read the story? Well, you start looking for patterns. For instance, the classic story of a healthy, growing company often looks like this. Positive cash from operations. The main business is humming along nicely. It'll probably have negative cash from investing because it's taking that cash and pouring it into future growth. And it might have positive cash from financing. Maybe they took out a small loan to really turbocharge that expansion. You see, it's these patterns that tell the real story behind the numbers.
By focusing on where the cash really comes from and where it really goes, you get a story that the profit number on its own could never ever tell you. It's the reality behind the accounting. So that brings us all the way back to the beginning. Let me ask you this again. If you could only look at one financial statement to judge what's really going on with a company, which one would you pick now? Yeah, I think you know the answer.